Welcome back to the Deep Dive. It is January 21st, 2026. So if you've been monitoring the ticker tape on the Jamaica Stock Exchange recently, you might be looking at your screens with, well, a profound sense of confusion.
It is certainly a disorienting time for the average investor.
Disorienting is, putting it mildly. To set the stage for you, we're witnessing a scenario that feels completely contradictory.
It really does.
On one side of the ledger, we have companies reporting what I can only describe as monstrous operational numbers. I mean, we're seeing record-breaking profits, margins expanding.
Efficiency ratios tightening. Fundamentally, these companies look incredible.
But then you look at the other side of the ledger, and the stock prices are just stagnant. Or worse, they're sliding backward.
And that's the defining characteristic of the Jamaican market as we start 2026. We call it extreme bifurcation.
Bifurcation.
Yeah. You have this unstoppable force of financial performance colliding with an immovable object of market sentiment. And that sentiment is currently being held hostage by fear.
Fear of what, exactly? Because usually, if a company reports, say, a 70% profit jump, the stock price rallies. That's investing 101.
In a normal market, yes. But we are not in a normal market. We're in a market dominated by what we are terming the governance discount.
The governance discount. Okay, let's unpack that definition before we get into the specific companies.
Certainly. The governance discount is a phenomenon where the market actively penalizes a company's valuation. It suppresses its share price significantly below its intrinsic value.
And this isn't because the business is broken.
Not at all. It's not happening because the business model is flawed or because customers have stopped buying the product. It's happening because the market has lost faith in the people holding the checkbook, either at the board level or, the major shareholder level.
So effectively, the market is looking at a company making billions of dollars and saying, I acknowledge your profit, but I just don't trust your governance, so I'm not buying.
That is precisely the standoff. It is a battle between audited financial statements, the hard math, and this nebulous yet powerful force of uncertainty.
And our mission today is to help you navigate this.
All right.
Because if you look closely, this isn't a bear market where everything is bad.
No, it's what we call a stock picker's market.
Meaning the index might be flat, but individual fortunes can be made if you pick the right horse.
Correct. Alpha generation earning returns above the average right now depends entirely on your ability to distinguish between a fatal governance red flag and an operational gold mine that's just, temporarily on sale.
Okay, so to do that, we're going to conduct a forensic analysis of 4 specific case studies. We should probably start with the heavyweight champion of the market, NCB Financial Group.
The giant in the room.
Yes, which is currently embroiled in this fascinating struggle between record profits and a shareholder debt crisis.
Then we'll pivot to the junior market to examine one-on-one educational services. This is our anomaly. We need to explain the mechanics behind a reported, what was it?
9,041% increase in net profit.
Right. It sounds like a typo, but it's not.
I still struggle to wrap my head around that number, but we'll get there. After that, we look at Express Catering Limited.
ECL.
On the surface, it looks like a perfect tourism recovery play, but there's a liquidity trap hidden in the balance sheet.
And finally, we'll look for an adult in the room. We'll discuss Grace Kennedy, which is acting as the defensive anchor in the sea of volatility.
Let's begin with the giant then. NCB Financial Group. Ticker NCBFG. If you were to look solely at the income statement for the fiscal year ended September 30th, 2025, you'd assume this company is the darling of the exchange.
You'd be absolutely justified in thinking that. The operational triumph here is, it's undeniable. We're looking at a consolidated net profit of $36.9 billion.
Let's just pause on that figure, $36.9 billion.
To contextualize that for you, it represents a verified 71% increase year over year.
71%.
Yeah. That's an absolute increase of $15.3 billion in a single fiscal year. For a mature banking conglomerate, growth of that magnitude is, it's typically unheard of.
So what's the engine here? Is this simply a case of high interest rates just padding the bottom line?
It's far more sophisticated than just interest rate spread. It's a combination of accounting evolution and really rigorous strategic execution. First, we have to address the adoption of IFRS 17.
IFRS 17. Now that sounds like the kind of accounting jargon that makes eyes glaze over. Why is it significant to an investor?
It's critical because it fundamentally changes how we view insurance profitability.
Hmm.
NCB owns Guardian Holdings, a massive insurance entity.
Right.
Under the old standards, revenue and profit recognition could be somewhat lumpy or delayed. IFRS 17 is designed to standardize insurance contracts. Essentially, it allows for a smoother, more economically accurate recognition of profit over the life of the insurance contract.
So it effectively unlocked value that was already there, but it just wasn't being shown on the books in the same way.
In a manner of speaking, yes. It materially boosted the reported results from the Guardian Holdings segment. It really validated that the insurance arm is a massive contributor to the group's health.
Okay, but you said it wasn't just accounting.
No, we cannot give all the credit to accounting rules. The core bank is also performing exceptionally well due to the EGC strategy.
EGC. Efficiency, governance, and customer experience.
It sounds like corporate rhetoric, but the data proves its efficacy. I mean, consider the economic environment of 2025. We had high inflation.
Everything was going up.
Costs for electricity, security, wages, everything was trending upward. In that environment, you'd expect a bank's operating expenses to balloon.
Right. Keeping the lights on and the servers running just costs more money.
Yet NCB managed to discipline their operating expenses to such a degree that they only grew by 5%.
That is actually remarkable. If inflation is running at, say, 7 or 8%, and your costs only grow by 5, your costs are arguably going down in real terms.
Exactly. And this creates what financial analysts call positive jaws. Your revenue is growing significantly faster than your expenses. The gap between the jaws widens, and that gap is pure profit.
And we see that in the core numbers.
We do. We see this in the net interest income, which was up 7% to 78.27 billion. The core engine of taking deposits and issuing loans is working flawlessly.
So, operationally, the bank is a fortress. It is printing money. 36.9 billion of it.
It is.
However, we must address the elephant in the room. Despite this blowout performance, the stock price as of January 20, 2026 is pinned at approximately $40.15.
Which implies a price-to-earnings, or PE, ratio of roughly 4 times earnings.
A PE of 4 for a dominant market leader is.
No.
That's incredibly low. Historically, this stock should be trading at 10 or 12 times earnings, maybe more. Why is the market ignoring the success?
Because the market is terrified of the chief shareholder debt crisis.
Right.
We have to discuss the situation involving Michael Leachin.
This has been dominating the financial headlines. But for clarity, this isn't the bank's debt, correct? NCB Financial Group itself isn't in default.
Correct. And that's a critical point. The bank's balance sheet is pristine. The issue lies above the bank. It concerns the private entities controlled by Michael Leachin, which act as the majority shareholder of NCB Financial Group.
So the owner is in financial distress.
Distress is the appropriate word. On December 31st, 2025, entities controlled by Mr. Leachin missed a mandatory bond payment of $94.1 million US.
Okay, now missing a payment is serious, but companies restructure debt all the time. Why has this caused such panic in the equity market?
It comes down to the collateral. To secure that debt, Mr. Leachin pledged over 1.024 billion shares of NCEFG.
1 billion shares.
Yes. And to provide scale, that represents approximately 41.4% of the entire banking group.
So almost half the bank is pledged as security for this private debt that is now in default.
Precisely. And the legal mechanisms have already been triggered. There was a forbearance agreement in place, a deal to give the debtor more time. However, that agreement contained a strict no flexibility clause. When the payment deadline was missed on New Year's Eve, it triggered a notice of acceleration.
Acceleration is a terrifying word in finance. It means the lender stops asking for the monthly payment and demands the entire principal balance immediately.
Correct. And the bond trustee, the entity legally responsible for recovering the money for the lenders, is now required to file in the Jamaican Supreme Court to enforce security.
Enforcing security means seizing the collateral, seizing the 1 billion shares.
And potentially selling them. This is the supply shock thesis. The market is paralyzed by the fear that the Supreme Court could authorize the seizure and liquidation of 1 billion shares of stock.
If 1 billion shares hit the open market tomorrow, there's no amount of buyer demand that could absorb that.
It would be a catastrophic supply dump. Basic economics dictates that when supply creates a glut, the price collapses. It would not matter that the bank earned $36 billion. The stock price would be crushed by the liquidation volume.
So investors are effectively on strike. They are seeing the value, but they refuse to buy until they know whether this liquidation event is going to happen or not.
It's a standoff. There is a 45-day cure period that began on December 31st. That timeline suggests we will reach a resolution or crisis point by mid-February 2026.
They're sitting on their hands.
It's a distressed value play. You are betting that the bank's performance will eventually outweigh the shareholders' personal financial issues.
That is the bet. And while you wait for the legal drama to resolve, you get a dividend yield of about 3.66%. They pay 3 times a year.
So you get paid to wait.
You get paid to wait. So it's not for the faint of heart, but the underlying engine of the bank is roaring. If that legal cloud lifts, the stock re-rates immediately. So for you, the listener, considering NCBFG, this is not an investment in the traditional sense. It's a binary wager.
It's entirely binary. If the debt issue is resolved, if Lee-Chin refinances or sells other assets to pay the debt, the governance cloud lifts, and the stock is fundamentally undervalued at 4 times earnings, it could double.
But if the court orders a liquidation,
It's a falling knife.
high risk, high reward, driven entirely by governance, it is a sobering situation.
Okay, let's pivot from the distressed giant to the high-flying anomaly of the junior market. Let's discuss one-on-one educational services. Ticker 1.
This is a fascinating case study in business model transitions.
I have to admit, when I reviewed the source material, I thought there was a clerical error. The report states they achieved a 9,041% increase in net profit.
It certainly looks like a typo, doesn't it?
It defies normal business logic. You don't just wake up one morning and have 9,000% more profit. I mean, how is this physically possible?
It's possible because of the specific nature of their business. They're an ed tech company. So
Yes.
to understand the number, we have to look at the transition from their build phase to their monetization phase.
Okay, let's break that down. What characterized the build phase?
For the past few years, one-on-one was capital intensive. They were building their proprietary learning management system, their LMS. They were hiring developers, filming educational content, building out the infrastructure.
So high expenses. Very high expenses. In accounting terms, they were incurring heavy expenses with relatively low revenue, which suppressed their profits to almost zero.
And in 2024, their profit was less than $1 million.
Just under, $9,400,000 to be exact, basically break even. But by 2025, the machine was built. The software code is written, the content is in the library. They shifted to monetization.
And this is where the unit economics of software come into play.
Exactly. The cost to add one additional user to a software platform is virtually zero. It's just server space. So as they started selling access to the platform they had already built, almost every dollar of new revenue flowed straight to the bottom line.
Hence the profit explosion to $85.93 million.
Correct. And crucially, they engaged in rigorous cost rationalization. Administrative expenses decreased by 13%. Selling expenses dropped by 24%.
That is the software dream. You spend less to make more because the product is digital.
And the margins prove it. Their gross margins have hit 82%. In the context of the Jamaican market, you rarely see margins that high outside of pure financial speculation. It validates the thesis that an edtech model can scale efficiently here.
But I have to play the skeptic here. Was 2025 a fluke? A one-time contract? I mean, is it sustainable?
That is the most important question, and it's a fair one. However, if we look at the Q1 2026 results, for the quarter ended November 30, 2025, the data suggests it is sustainable.
Where did that show?
Net profit doubled again to $22.57 million. But here's the critical data point. Revenue actually dipped by 9% in that quarter.
Wait, revenue went down, but profit doubled.
Yes.
That seems counterintuitive. Usually you need to sell more to make more.
Not if you have pricing power and extreme efficiency. This decoupling of revenue and profit is the hallmark of a mature software business. It suggests they're shedding low-margin revenue and focusing on high-margin subscriptions. They don't need to increase top-line volume to drive bottom-line growth because their cost base is so low.
That is a powerful position to be in. However, it is the junior market, so volatility is the price of admission.
Indeed. We often refer to stocks with this kind of retail interest as meme stocks, but in this case, the meme is backed by audited operational leverage. It's a legitimate growth story.
So we have the distressed value play in NCB and the high growth play in One. Now let's look at a company that appears successful on the surface, but is hiding a significant governance risk. Express Catering Limited, ticker ECL.
This is what I categorize as the liquidity trap.
On paper, this looks like a straightforward turnaround. Express Catering operates food and beverage outlets at the airport. Tourism is booming, passenger numbers are up, people are spending money.
And the income statement reflects that recovery perfectly. Net profit was 3.76 million US dollars for the year. That's a 167% increase. Revenue was nearly 26 million.
So if you were just running a computer screen on the numbers,
If you were running a quantitative screen based purely on growth in PE, you would buy this stock immediately.
but we are digging deeper than the computer screen, what are the red flags?
The first warning sign comes from the boardroom. On October 17th, 2025, the long-serving chairman, Herrick Deere, resigned. Before that, an independent director, Tanya Waldron-Gooden, also departed.
Why should the average investor care about boardroom resignations? I mean, people quit jobs all the time.
In the world of corporate governance, high-profile resignations, especially of independent directors and chairmen, during a period of reported financial success are a major signal.
Okay.
Independent directors are the guardians of minority shareholder interests. When they leave abruptly, it often signals internal friction or disagreement with the direction of the company.
And on top of that, they missed regulatory deadlines for filing their reports.
Delayed financials are rarely good news. It implies a struggle between the auditors and management or weaknesses in internal controls. But the liquidity trap I mentioned is visible in the balance sheet. We need to discuss due from related parties.
Walk us through this. What does that line item mean for ECL?
It means that approximately 30% of ECL's total assets, roughly 17.6 million US dollars, is not cash in the bank nor inventory in the fridge. It's money owed to ECL by its parent company, Margaritaville Caribbean Group.
So the company is generating cash from operations, but instead of that cash staying in ECL to pay dividends to shareholders or reinvest in new stores, it's being loaned to the parent company.
Correct. And typically, these intercompany balances are unsecured.
That sounds incredibly risky. If the parent company runs into financial trouble, that $17.6 million asset could effectively evaporate.
That is the risk. It is effectively an unsecured loan to the majority shareholder. This is why the market is applying a discount. You aren't just betting on whether ECL can sell burgers at the airport. You are taking on the credit risk of the parent company, which is an entity you have very little visibility into.
It creates a situation where the company is operationally a cash cow, but the minority shareholders can't reach the milk.
A very apt metaphor. The cash is trapped at the parent level.
We have covered distress, explosive growth, and governance traps. Is there anywhere in this market that offers safety? Is there an adult in the room?
There is. In this chaotic environment, Grace Kennedy stands out as the defensive anchor, ticker GK.
Grace Kennedy has always been viewed as a proxy for the Jamaican economy, but you're arguing it's more than that now.
It's much more. While NCB fights legal battles and ECL sees board turnover, GK is projecting absolute stability. They've established a net profit floor exceeding 8 billion Jamaican dollars annually. They delivered 8.4 billion in 2024.
And the 9-month numbers for 2025 were strong too.
Very. For the first 9 months of 2025, revenue was nearly 134 billion. But the critical point of differentiation is where that revenue comes from.
It's not just local.
Exactly. It's not just domestic. GK has evolved into a true multinational. A massive portion of their revenue is derived from international markets, the UK, the USA, and Canada. This geographic diversification is their superpower.
So if the Jamaican economy slows down.
GK is insulated because they're earning hard currency abroad.
Now, they recently navigated a significant leadership transition.
Yes, and leadership transitions can often be moments of vulnerability for a stock. However, the appointment of Frank James as Group's CEO on February 14th, 2025 was executed flawlessly.
Why is Frank James the right choice for this moment?
Because he represents continuity. He isn't an outsider coming in to shake things up. He was the group CFO. He understands the balance sheet better than anyone. His appointment signals to the market that the strategy remains unchanged.
And that strategy is Vision 2030. We keep hearing rumors about a dual listing.
It is more than a rumor, it's a mandate. The goal is to list GK on a major international exchange, likely the NASDAQ or the London Stock Exchange.
Explain the significance of that. Why does listing in New York or London matter for a company based in Kingston?
It's about valuation arbitrage and access to capital. Right now, GK is priced in Jamaican dollars by Jamaican investors who are, cash constrained. If you list on the NASDAQ, you expose the company to a global pool of capital trillions of dollars looking for stable, dividend-paying consumer goods companies.
So the theory is that international investors will pay a higher multiple for the same earnings than local investors will.
Precisely. It typically leads to a re-rating of the stock price. And they're preparing for this stage. They're acting as an acquirer. In January 2025, they acquired 100% of Catherine's Peak Bottling Company. They're strengthening the portfolio to look as attractive as possible for that international debut.
Currently, GK is trading at a PE of around 8.9, so it isn't as cheap as the distressed banks, but it isn't expensive either.
It's fairly priced for safety. Its primary value proposition right now is capital preservation. In a turbulent market, GK is where you park your capital if you want to sleep soundly at night.
Can't stress this enough. They are not just a local Jamaican company.
No, they have a global footprint.
If you walk into a Sainsbury's in the UK or a major supermarket in North America, you are going to see Grace Kennedy products.
Oh, yeah, you see the sauces, the seasonings.
Hot sauces, canned goods, seasonings. That means they earn revenue in hard currency. Pounds and US dollars. That acts as a natural hedge against the local economy.
So let's look at the metrics for January 2026. Where are they trading?
As of yesterday, the 19th, they were hovering around, let me see, $71.49 Jamaican. Now, for our international listeners, the exchange rate fluctuates, but think of this as less than 50 pence.
Less than 50p or roughly 45 US cents per share. That feels incredibly low for a multinational food distributor.
It's his historic value. If you look at the 18-month range, they've bounced between about $69 and $78.
Okay.
So at 71, they are sitting at the lower end of that channel. The implied upside, to just get back to their recent high, is around 10%. But the real story here isn't just about the stock price jumping up.
No.
It's about the earnings floor.
I love that term, earnings floor. Let's unpack that. What does it actually mean for an investor?
It means stability. It means that regardless of what is happening in the economy, whether inflation is up or down, whether there's a hurricane or a drought, people have to eat.
People have to eat.
Grace Kennedy consistently maintains annual earnings over 8 billion Jamaican dollars. If you look at the bar charts in our source material from 2021 through 2025, it is just a steady, boring block of green.
Boring is good when markets are volatile.
Boring is beautiful, and they pay you to be bored. In 2025, they paid out $2.37 per share in dividends.
Okay, and what does that work out to as a yield?
That's a retrospective yield of about 3%. It's not going to make you rich overnight, but it's consistent income while you wait for that capital appreciation.
Now, here's where it gets really interesting to me. The source material mentions a specific theory about Grace Kennedy's future, the takeover target theory. This feels like the hidden upside.
This is the spice in the stew. If you look at the history of Jamaican conglomerates, you see a pattern. Look at D&G, famous for Red Stripe beer.
Right, Heineken?
Look at Lascelles de Mercado, which owned Ray and Nephew Rum.
Campari.
They reached a certain size, they built incredible brand equity, and then a huge overseas player swooped in. Heineken bought Red Stripe. Campari bought Ray and Nephew.
Because it was easier for those global giants to buy the brand than to try and compete with it.
Exactly. The analysis here suggests GK fits that profile perfectly. A massive global food company, maybe a Nestle, maybe a Kraft Heinz, could look at GK's distribution network and that loyal customer base and say, we want that.
So the thesis is, you buy a solid, boring food company at a cheap price, $71, you collect your 3% dividend, and you hold a lottery ticket that maybe, just maybe, a global giant buys you out at a massive premium.
Before we move to our final synthesis, I want to briefly touch on one more company that defies easy categorization. Jamaica Teas Limited, ticker JAMT.
JAMT is a hybrid, and it's often misunderstood by retail investors.
People hear the name and assume it's strictly a manufacturing business. You know, they make tea.
And they do manufacture tea very successfully. However, structurally, the company is a manufacturing entity attached to a significant investment fund.
How significant?
A verified 39.3% of their total assets, approximately $2.22 billion, are invested in quoted Jamaican equities. This is primarily managed through their subsidiary QWI Investments.
So when you buy a share of JMT, you are effectively buying a tea factory and a mutual fund.
Correct. And this structural reality explains the nuance in their performance. For 2025, their net profit recovered to $260.6 million. On the surface, that looks like a fantastic operational turnaround.
But there's a catch.
But if you peel back the layers, you see that the recovery was largely driven by $159 million in investment income.
So their profitability is heavily correlated to the performance of the stock market itself.
Exactly. If the JSE goes up, JSE's bottom line swells. If the market crashes, their profits take a hit, regardless of how much tea they sell. They are currently rationalizing non-core assets, specifically selling off real estate to focus on this core blend of manufacturing and investment, but you have to understand you're buying market beta.
This has been a dense tour of the market.
Mhm.
Let's try to synthesize this for everyone listening.
Yeah.
We started by stating that the market is at war with itself, a stock picker's market.
That is the only logical conclusion. If you were to buy the broad index today, the JSE combined index, you're buying stagnation.
Why?
Because the governance risks at NCBFG, which has the largest weighting in the index, are effectively canceling out the operational wins at companies like One-on-One or Grace Kennedy. The average is flat, but the components are moving violently in opposite directions.
So let's summarize our findings using a risk-reward matrix. If you're looking at the board, how should you categorize these opportunities?
Let's break it down into 4 distinct quadrants. Quadrant 1 is distressed value. This is NCB Financial Group.
High risk, high reward.
Exactly. It's trading at 4 times earnings. If the Supreme Court ruling is favorable and the debt is restructured, the stock could double. If the shares are liquidated, it crashes. It's a binary event.
Okay, quadrant 2.
High growth. This is One-on-One. The risk here is execution and volatility. Can they maintain those 80% margins? But the reward is exponential growth as they monetize their platform.
Quadrant 3.
Governance warning. This is express catering. You have strong earnings masked by a dangerous balance sheet. The related party loans create a liquidity trap. It's high risk, but the operational turnaround is real if, and this is a big if, they can resolve the governance issues.
And finally,
The defensive anchor. Grace Kennedy. Low risk, steady international growth. It is the safe choice for capital preservation and steady compounding.
it's clear that the days of buying any stock and watching it go up are over. This market really requires a forensic approach.
Absolutely. In 2026, you cannot simply read the headline profit number. You have to investigate who holds the shares, where the cash is actually sitting, and who is sitting on the board. If you don't perform that due diligence, you are flying blind.
I want to leave our listeners with a final provocative thought to chew on. We've discussed intrinsic value extensively today, the idea that a company is worth a certain amount based on its cash flow. But consider this. If a company makes $36 billion in profit, but the shares are locked in a legal battle in the Supreme Court, does that profit even matter to the stock price in the short term?
It is the ultimate philosophical question of investing. Is a stock worth its future cash flows, or is it only worth what the current legal and governance structure allows it to trade for?
And that leads to the ultimate decision. Is this current market environment a warning sign to stay away until the dust settles? Or is this a generational opportunity to buy incredible assets, like a major bank or a booming tech company, while they're artificially suppressed by governance issues that are ultimately solvable?
Fortunes are always made in the gap between perception and reality. The question every investor must answer for themselves is, how wide is that gap right now?
A critical question to ponder. Thank you for joining us on this deep dive into the Jamaican equity market. We will catch you next time.